Bitcoin just smashed its all-time high, but is it too late to buy? With massive U.S. regulation on the table and billions flooding in from ETFs, some analysts are now looking at altcoins for the next big move. Is the market about to go into an unimaginable frenzy, or is a local top just around the corner? Find out now. In the latest video from Altcoin Daily, the host explains that this week is huge for crypto because of major regulatory bills heading through the U.S. House. Bitcoin just hit another all-time high and is on pace for its highest weekly close ever. But the bigger story is the legislation. The Genius Act for stablecoins and the Clarity Act for market structure are set to be addressed. This is a massive deal because for the first time, there would be clear rules for the crypto market. The video argues this could be even more impactful than the Bitcoin ETFs. The video does a great job of capturing the market's excitement around the potential for U.S. crypto regulation. The bill mentioned, formerly known as the FIT21 Act, did pass in the House of Representatives, which is a major milestone for the industry. However, the optimism in the video should be met with a dose of reality. The bill still has to get through the Senate, where its future is much less certain. Furthermore, SEC Chair Gary Gensler has publicly stated his opposition to the bill, arguing it could undermine existing investor protections. It seems the political fight for clear crypto rules is really just getting started, even if the industry has won an important early battle. In the latest video from the Crypto Rover channel, the host explains that Bitcoin's latest surge to a new all-time high of around $122,000 was kicked off right as U.S. futures markets open. This suggests that the U.S. stock market is betting big on higher prices. With over $2.2 billion in ETF inflows in the last 2 trading days, we could see even more action today. The host also expects Michael Saylor might announce another large Bitcoin purchase soon for MicroStrategy. A big event to watch is the U.S. House vote on a crypto market structure bill, which could send the whole market flying if it passes. The video does a good job connecting Bitcoin's price movement directly to the U.S. market's activity, especially the massive ETF inflows, which is a major theme right now. The price targets mentioned are based on standard technical analysis, which is what you'd expect. What's interesting is that while the video focuses on technicals for Ethereum's strength, it overlooks the massive fundamental shift that just happened with its Dinkin upgrade. This upgrade dramatically reduced transaction fees on Ethereum's Layer 2 networks, making the ecosystem much more usable and affordable. This is a huge development that likely adds a lot more fuel to Ethereum's fire than just chart patterns alone, potentially supporting that run to $4,000 and beyond. In the latest video from Lark Davis, he kicks things off by celebrating Bitcoin's massive pump to a new all-time high of $123,000. While he's excited about the move, he suggests it might be a bit late to chase Bitcoin right now, pointing to better opportunities in altcoins. He personally thinks that $150,000 could be the next local top for Bitcoin, possibly hitting that mark around August. A major reason for this surge is the incredible demand from Bitcoin ETFs, which bought a staggering $2.7 billion worth last week, far more than the 450 Bitcoin being produced by miners each day. He also touches on the explosive possibility of China reversing its crypto ban, a move he believes would send the market into an unimaginable frenzy. It's hard not to get caught up in the excitement when you see numbers like $123,000 for Bitcoin. The point about ETF demand outstripping miner supply is a very powerful narrative that's been driving the market for months. It feels like a genuine structural shift in how Bitcoin is valued. The inflow of money from these traditional finance giants is undeniable. However, the talk about China reopening its doors to crypto is a narrative that resurfaces every bull run. While Hong Kong's approval of crypto ETFs is a positive step, a complete policy reversal from mainland China seems like a long shot for now. It's an exciting what-if that adds fuel to the fire, but the ETF story in the US is the one with real, verifiable data behind it today. The meme coin discussion is also interesting. It shows just how much this cycle is driven by social media trends and community hype, not just technology. In the latest video from the Ben Cowan channel, the focus is on Bitcoin's return on investment, ROI, after its 4-year halving events. He shows how each cycle's returns have gotten smaller over time, a concept he calls diminishing returns. He points out that while cycles 1 and 3 shot up right after the halving, cycles 2 and the current one, cycle 4, both had a 15 to 20% dip first. Cowan presents a very grounded, first look at Bitcoin cycles. His argument for diminishing returns is historically sound and serves as a necessary reality check. However, this cycle has a major variable that previous ones didn't: the launch of spot Bitcoin ETFs in the United States. The sheer volume of institutional capital flowing through these products is a new force at play. This has created a big debate among analysts. Some believe this new demand could break the old pattern of diminishing returns, while others think that even with the ETFs, the math of a multi-trillion-dollar asset still applies, making massive multiples harder to achieve. This cycle feels like a test between established historical patterns and the powerful influence of new institutional money. In the latest video from Coin Bureau, the host breaks down an insightful article by macro analyst Lynn Alden called "The Rise of Bitcoin Stocks and Bonds." The video tackles the big question of whether companies and institutions buying up huge amounts of Bitcoin is good or bad for the network. It turns out some investors prefer buying stock in a company that holds Bitcoin, like MicroStrategy, rather than buying Bitcoin directly. That's because these companies can use clever financing, like corporate bonds, to get leverage and buy even more Bitcoin without facing the same risks of forced selling if the price dips. The video does a great job of explaining a complex topic in simple terms. This conversation is more relevant than ever. The trend of corporate treasury companies is not just theoretical, we're seeing it play out in real time. The approval of spot Bitcoin ETFs in the US was the starting gun, making it easier and more acceptable for corporations to add Bitcoin to their balance sheets. It feels like the Suitcoiner era, as the video calls it, is really just getting started. This introduces a fascinating new dynamic. While the Bitcoin network itself remains decentralized, its price action is becoming more tied to the decisions of a handful of large, publicly traded companies. It's a trade-off. Bitcoin gets immense validation and capital inflows, but it also inherits some of the risks from traditional finance, where a single company's bad quarter could create waves across the entire crypto market. In the latest video from Crypto's Russ, the host lays out a very bullish case for the upcoming week in crypto. With Bitcoin sitting right at its all-time high of around $119,000, he believes the next leg up to the $130,000 to $150,000 range is near. He points to three major developments this week that could fuel the rally. First, the U.S. House is set to discuss three significant crypto bills: the Clarity Act, the Genius Act for stablecoins, and an anti-CBDC bill, any of which could bring positive momentum if they progress. Second, a new CPI inflation report is due on Tuesday. If the numbers come in low, it could cause markets to explode upwards, as recent tariff impacts haven't really shown up in prices yet. Third, he points to the massive ETF inflows, which hit $2.7 billion last week. If this buying pressure continues, there won't be enough Bitcoin in OTC markets to satisfy demand, which naturally drives the price higher. Finally, he discusses the possibility of an altcoin season starting. He notes that major projects like XRP, Cardano, and AVAX have seen good gains. He specifically thinks Solana, SOL, is underperforming despite its outstanding metrics and is due for a big week as money rotates into it. The key sign to watch for is if money starts flowing from the record-high stablecoin supply back into altcoins, pushing Bitcoin dominance down. From my perspective, the video captures the current on-the-edge feeling in the market really well. The focus on both macro factors like the CPI report and crypto-specific events like the legislation is spot on. The talk about crypto bills in Congress is particularly interesting. While getting these bills on the floor is a positive step, the political process is notoriously slow and often unpredictable. Realistically, we're likely looking at a long road before any of these become law. As for an altcoin season, the signs are certainly there, but it still feels a bit tentative. We've seen several false starts where altcoins rally for a few days only to be pulled back down by Bitcoin's gravity. It seems the market is waiting for Bitcoin to definitively break its old high and establish a new support level before capital feels confident enough to flood into more speculative altcoins in a sustained way. The ETF flows remain the most powerful and consistent driver, and as long as that trend holds, the baseline outlook remains strong. In the latest video from the Crypto Banter channel, David explains how he went from being a terrible trader to a profitable one by using automated trading bots. He shares a personal story about how he used to make emotional trading mistakes and even lost most of his bull run profits during the Luna crash because of a flawed DCA bot. That experience led him to develop his own platform, the David Tech website, which hosts over 1,200 different trading bot strategies. David's pitch is compelling because it addresses a core problem for many traders: emotion. Taking human error out of the equation is a big part of what makes automated systems attractive. The platform's focus on showing both back-tested and live trading data is a nice touch, offering a layer of transparency that isn't always present in the bot space. The bot army concept is a catchy way of branding portfolio diversification, which is a classic risk management strategy. However, a bot is ultimately just a tool for executing a strategy. The real work is still in selecting a strategy that can actually handle the crypto market's intense volatility. As his own story about Luna demonstrates, even an automated system can fail spectacularly if the underlying strategy isn't prepared for a black swan event. The tool seems useful, but its effectiveness is entirely dependent on the quality of the strategies you choose to run.